From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. Right now, we are seeing a little lift ahead of the Thanksgiving break. The S&P up about 0.5%, the Nasdaq up. Similarly, the countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
We begin with the big issue, seeing more pain until the pivot.
There's still a lot of hawkishness yet to come and feed through from the Fed.
Underweight in equities at the moment.
Stocks can still lag from here.
Another move down.
I could see another 5-10% lower on this equity market.
How many more rate hikes will we get?
Waiting for that moment when the Fed is likely to pivot.
Pivot from the Fed.
Equity markets in general, I think, are fraught, until such time.
We've seen more positive signals.
We had one good data point.
I do think that people are being a little bit too optimistic.
You want to have another data point confirming that the disinflation trade is on.
Markets will increasingly be pricing in the impending downturn that's to come.
The playbook is you have to get defensive.
Joining us now, Nuveen's Brian Nick and Nadia Lovell of UBS. Pain until the pivot. Brian, is that your idea as well? That basically we need to see ongoing revisions to earnings, ongoing revisions to valuations until the Fed blinks?
I think that's right. And they made that pretty clear. I think the markets are really focusing on the fact that the Fed's likely to decelerate the pace of hikes. I think they're focusing less on the promise of more hikes into the future and maybe a higher terminal rate. So until the market gets that pricing right, it feels like it's going to be status quo, which for 2022 has been interest rates are going up and they're going up by more than you think. And it's very hard for diversified investors to navigate through that environment cleanly. So then becomes the question, how high is the bar for the pivot or for perhaps the cutting of rates? Because the pivot is not just simply stopping on raising those rates. Nadia, what's your view?
Yeah, we think that is going to require inflation to really come down. The most recent inflation number is encouraging, but it's still too early to have the party. We think you're not going to get something with a 2% handle until the later half of 2023. And that's when the Fed might be able to take their foot off their pedal and cut. We do expect another 50 basis points in December, then another 50 in 2023. And we think that the Fed will pause in the early part of the year, but it will take a lot more to get a pivot. And the Fed is keenly focused on the labor market. So we also need to see the unemployment rate sort of tick up before the Fed will be comfortable in doing a rate cut.
And there's a lot of faith right now in the idea of lag effects, the idea that the rate hikes that we've seen this year from central banks around the world will start to really bring inflation down more sharply next year. The OECD not necessarily agreeing, raising its inflation forecast for 2023, saying, quote, right now, controlling inflation has to be the top priority or we end up with a situation that inflation becomes so entrenched that the pain needed to control it will be even greater. Risks of overshooting are certainly less than risks of inaction. Brian, based on the lag effects, based on the tea leaves that we've seen in the housing market and other sort of first movers in response to the rate hikes, do you think that this is true?
I don't actually. I think that we're going to see inflation come down in the first half of next year pretty quickly for reasons that may not have anything to do with what the Fed's up to. We're seeing goods price deflation. It's about as powerful as we've ever seen. We're seeing energy prices, potentially also food prices starting to roll over. So if those things that are sort of around the periphery of what the Fed's able to control start to cause inflation to moderate, start to cause real wage growth to turn from sharply negative, which it's been all year, to positive, that could actually be a bit of a tailwind for consumers who, yes, are going to have to face the lagged effect of higher interest rates, potentially less hiring going on, less negotiation for nominal wage growth in their jobs. But as long as real wages are coming up because inflation is moderating, I think we should see the consumer carry us forward at least into the second half of next year. Which raises a question of whether we really can see the shallow recession, Nadia, that so many people are expecting. This idea that we can get some sort of, I don't want to say Goldilocks scenario, but a place where the Fed can really cut rates. Do you feel like there is more resilience that we're seeing in the earnings of retailers and beyond from consumers than to allow some of the lag effects to just take hold and inflation to really keep going up?
We do think that you can achieve a shallow recession next year. The consumer does remain quite strong. We're seeing the spending in retail earning this week and also in terms of retail sales. But, the consumer spending is shifting. It continues to shift away from goods and towards services. I think what's given consumer confidence in spread to spend is the labor market. The unemployment rate still remains pretty low at 3.7%. We're seeing more layoffs in tech. And if that becomes more widespread, then we think that the consumer will be more concerned about job security and probably tighten their belt as we get into 2023. But the consumer balance sheet remains very strong, and so does corporate balance sheet. And the consumer does have a lot more fixed debt than it did versus variable debt that it did in the last financial crisis, and as does corporates. And so we think that because of the health of the balance sheets, that will allow for a more shallow recession than we've seen in the past.
And Veronica Clark over at Citigroup also pointing to next week's jobs data. Take a listen to what she had to say.
Next week, of course, we'll get a lot of labor market data. That will be very important. For the Fed right now, if we do get some slowing in inflation, which it seems like we might, but you're not seeing it in the slowing in service inflation, that's related to a tight labor market. And then you do need to see that loosening in the labor market data.
Nadia, from your vantage point, is the tech industry and how much we have seen the layoffs picking up there a sort of precursor to what to expect more broadly, or an idiosyncratic sort of mismatch in size and staffing based on the mismatch in expectations for certain companies?
I think that tech isn't reflective of the broader economy, and tech is really where the excesses were. Tech is a pandemic beneficiary, so there was a pickup in hiring, and now companies are trying to right-size that. There's still other areas of the economy that does continue to have labor shortages. I mean, we heard throughout the earnings season, particularly from some of the Air Force and defense companies, that they've lost engineers to tech companies. So now some of that can reverse, and maybe the hiring can pick up in some of those areas we've seen shortages. And so we don't think that tech is a broader look on the economy, but we do expect the unemployment rate to pick up. I mean, even the Fed itself in their forward projections is looking for a pickup in the unemployment rate.
Meanwhile, investors assessing the lag, what we've been talking about between monetary policies and the effect in the real economy. San Francisco Fed President Mary Daly weighing in. Take a listen.
As we work to bring policy to what we call a sufficiently restrictive stance, which really in simple terms means the level required to bring inflation down and restore price stability, we will need to be mindful. Adjusting too little will leave inflation too high, and adjusting too much could lead to an unnecessarily painful downturn.
Joining us right now, I'm very happy to say, is Bloomberg's very own Michael McKee. Mike, so much Fed speak, a very similar message across the board.
Yeah, that's pretty much the case. I mean, Mary Daly laying out kind of the existential question, which begs the question of what is the right level for the federal funds rate. There's an old saying, it's hard to make predictions, particularly about the future. The markets are predicting that the Fed's going to continue raising rates. They've got 50 basis points priced in for December, and then 325 basis point moves after that. And then they think they're going to cut. Now, the Fed doesn't think so. And their argument is we get to the terminal rate, and as Lisa said, there's more and more agreement it's going to be 5%, give or take 13 or 15 basis points. They're going to leave the terminal rate where it is for 12 to 18 months. Now, that's going to depend on what happens with the economy, and I think some of your earlier comments address that. The idea that we're going to now have to start paying attention not just to inflation, but to growth and unemployment. The OECD forecasts out this morning show the U.S. slowing to just 0.5% growth next year, which is a little bit stronger than the Bloomberg consensus forecast this month. And of course, the Fed hasn't made a forecast since September. They'll make one in December, so we can't really count them, but this is where they are. They think, the OECD thinks PCE core rate will decline to 3.6%. Bloomberg economists a little more optimistic than that, and unemployment doesn't rise very much under the scenarios, but if it does the Fed have to react? Well, that means that you got to stop paying attention to what they're going to do in December and what they're saying now and tomorrow and the next day, and start looking ahead to the data that come out between now and, say, March or May, when the meetings are that they might end up with what they're doing. So write this down. You've got CPI coming out every month. middle of the month. GDP, the fourth quarter numbers come out at the end of January, the first quarter numbers at the end of April, and then these unemployment numbers. If we see deterioration in the numbers, then we're going to see the Fed perhaps start to change its tune. If we don't, then the Fed may hold where they are, and we'll see what we end up with, but we're not going to be able to tell people in the markets right now.
Michael McKee, thank you so much. Brian, Nick, and Nadia Lovell still with us. We are getting a host of data out tomorrow, in particular having to do with the housing market. Brian, I'd love your perspective on what you're expecting with that, given that we have seen the sales slow, but not necessarily prices decline as much as some people might expect.
Yeah, that's also because what the Fed's been up to, and they've been very clear about it since the beginning of this year, tightening policy has also impacted the supply side. So while there's still a lot of homes in the process of being built, there aren't that many new starts, there aren't that many building permits, the architectural hirings have gone down. So the leading indicator for all this housing construction have really struggled and are plummeting at some of their fastest paces we've ever seen. And that's because this sector of the economy is very interest rate sensitive. To the extent this is going to affect things beyond just the housing market, it's going to continue to hit the demand and I think eventually the prices for durable goods, the types of things that people buy when they move into a new home. If sales have slowed down, there just aren't as many people moving into new houses for the foreseeable future. You're going to see furniture, appliances, all the things that people use to fill those homes, the price of those things are going to continue to move down. So overall, the Fed is accomplishing some measure of sort of disinflationary, deflationary pressure, but they're doing it sort of a bank shot via the housing market.
Brian, when we head into 2023, what are you most confident in terms of some sort of asset class to hide out in?
I'm much more confident that fixed income is going to have a reasonably good year, certainly compared to 2022, which is not much of a bar for sure, considering it was the worst year we've seen.
Ever.
But I think if we're talking about the scenario next year where the Fed hikes rates to say 5.25, somewhere around there, and just holds them there, and the economy doesn't have a hard landing, and the Fed's able to keep downward pressure on inflation, that's going to be a pretty good year for fixed income. Not a great year, not a 2014, not a 1995, but if you're just clipping coupons at this new high and I think probably temporary level of interest rates, I think as a fixed income investor, you're going to be much happier. Equity markets, I think, are going to be more troubled by the Fed holding rates at that level, and it's going to be harder to see that kind of that slow grind lower in growth, causing companies to be able to sustain profit margins at the current levels.
Nadia, do you agree with this? It seems like increasingly this is the consensus, that bonds are a good place, at least safer bonds in the U.S. Equities, not so much in 2023.
Yeah, we agree with that for the most part. We think that that higher coupon that, investors can clip can help to have some cushion within the fixed income market. Within the equity market, we remain somewhat cautious still. We still think that the consensus expectations for earnings are too high. I mean, we have a market that's rallying into year end and sort of trading as if the economy is going to expand and PMIs are going to expand in 2023. We think that they're going to contract, and we think that, estimates at the very least is going to contract by at least 4%. And if we end up in a deeper recession, you could see a 20% contraction. So we just don't think that the risk reward is set up very favorably for the equity markets as we head into 2023. And we think that some of those lows that we have seen recently can be retested in the first half of the year. So we would be more in favor of the fixed income market at this stage versus the equity market. We think that investors will get a better entry point in the equity market in the first half of next year.
Nadia Lovell, Brian, Nick, both of you are going to be sticking with us. Let's take a look right now at some of the stocks that are moving ahead of the opening bell. Here is our own Abigail Doolittle. Abby.
Hey, Lisa. Well, on oil's rebound after a wild ride yesterday around various headlines on OPEC Plus and a possible Saudi output hike, which was not true. We have energy stocks rebounding as well. ExxonMobil, Chevron, and Occidental all higher. Turning to retail, some positive reports out of both Abercrombie Fitch and Best Buy has those stocks higher. On the other hand, Zoom and Peloton, those pandemic darlings, well, not so much. Record low revenue growth for Zoom. That really tells the story, Lisa.
Thank you so much, Abigail. Meanwhile, coming up, China's painful reopening threatening more economic strain.
We are not full on the China reopen trade right now. We still stay a bit cautious here, so we are still a bit underweight in the Chinese space.
That conversation still ahead. From New York, this is Bloomberg.
full on the China reopen trade right now. We still stay a bit cautious here, so we are still a bit underweight in the Chinese space. However, if we would see a change in things, we would start to add onto the consumer side, where we think there's still potential for growth and also reopening to happen.
China COVID infections continuing to march higher, restrictions now weighing on a fifth of the nation's economy, fueling tensions at home as tensions simmer abroad. The U.S. pressing China to ease up on Taiwan. Defense chiefs at a meeting in Cambodia are scheduled to. Bloomberg's Kaylee Lyons here in New York and Josh Wingrove in D.C. joining us now. Josh, what's the latest when it comes to some of the tensions right now?
Well, we've seen the U.S. sort of roll out this sort of drumbeat of visitors to the Indo-Pacific region. Of course, Joe Biden was there last week. Kamala Harris, Lloyd Austin, the defense secretary, this week. And, you know, that bilateral meeting about a week ago with President Xi Jinping and President Biden really was a watershed moment in those U.S.-China relations, in particular under this president who has kind of, you know, talked a lot about having spent a lot of time with Xi Jinping, being able to sort of speak his language a little bit proverbially and see where they're going. So I think what they were trying to do is bring down the temperature. It seems that has been the case. The sort of mood music, if you will, out of that bilateral meeting has been pretty positive. And the question is, where does that go from here? They're sort of reopening channels that had been kind of dormant or, you know, slammed shut in the aftermath of Speaker Pelosi's visit to Taiwan. The question is how far that reopening goes, you know, and whether it can last. You know, has this all been a little bit of cleanup on Pelosi? At least implicitly, yeah, a little bit. And so, of course, the other question is, are there other visits that could happen to Taiwan, other members of Congress, for instance, that could sort of set off the Chinese in a way that Pelosi's visit did and sort of send us back to square one?
When you talk about reopening in morale or in relationships with Taiwan and China and the U.S., there's also the reopening when it comes to COVID. Kaylee, a lot of people talking about how there was a shift in tone from China in terms of perhaps easing off zero COVID. The latest cues, perhaps not as sanguine.
Yeah, it was relatively recently that China was talking about easing up on some of the most restrictive control measures. It was only about a week ago, and yet what we are seeing on the ground in the country now is a rise in the virus caseload. About 27,300 cases were reported on Monday. That is just shy of the previous record of 28,973, which was reached in April when the Shanghai outbreak led to a surge in infections. In this current wave, it's Guangzhou that is the epicenter with the bulk of infections. China's top health officials are vowing to stick to COVID zero. Beijing is telling local governments to implement those updated guidelines and not be excessive when it comes to controls. But still, we are seeing these measures being put back into place. Nomura, as you mentioned at the top, Lisa, says roughly 20% of China's economy is currently being affected by restrictions. Even though we aren't seeing citywide lockdowns being ordered, about 48 cities are subject to some form of district level or widespread movement restrictions, and local authorities in big cities have also reintroduced measures like expanded testing and closing schools and offices. So as a result, Nomura says the path to reopening in China is going to be slow, painful, and bumpy, and they only expect GDP growth of about 4.3% in the country next year. No surprise, all of that has started to weigh on market sentiment. We all have been clinging to optimism about the reopening of this economy. Chinese tech stocks in particular, a really good example of that frenzy in the first half of this month. From the beginning of November through the 15th, the Hang Seng Tech Index rallied 33%. But in recent days, as the headlines have started to shift, we have seen some of those gains given back. Now only up about 23% on the month. And of course, that's carrying through to some of those ADRs of those big tech companies that are listed here in the U.S., Lisa.
Kaylee Lyons and Josh Wingrove, thank you both so much. Brian, Nick, and Nadia Lovell are back with us. Nadia, from your vantage point, one of the key consensus calls heading into next year is that China will outperform based on the low expectations. In your year of inflection points, do you see that as a likelihood?
You know, we think it's going to be a bumpy ride in China. It's going to be volatile as the reopening process happens. It's going to take a long time. We're not really looking for any meaningful change in the reopening process until the third quarter of next year. We think it's going to be fixed and starts, and that's going to create some volatility. So we are neutral on China. We think as you get into 2024, then it can become more attractive.
So meanwhile, Brian, from your vantage point, do you see this as a possibly good thing or something that could be potentially problematic if China reopens more in full based on the demand side for commodities, in particular crude and natural gas?
Yeah, I think it's very difficult to try to identify silver linings from the situation, but there's no doubt that the China lockdown policies have had a disinflationary effect on global inflation. Inflation would have been worse over the summer. We would not have seen probably the decline in commodity prices, where most of the disinflation we've seen so far has come from. And so if these policies stay in place because the virus is still spreading there in a way that's unacceptable to the policymakers, I think all in all, that's going to be disinflationary. I think the initial fears were that this was going to disrupt manufacturing and cause supply chains to stay disrupted for longer. But two things are happening at the same time. One is companies are finding ways to reroute around China. And two, I think more importantly, global consumer demand for goods that are made entirely or partially in China is falling in its own right because people have rotated into services. So less of a big deal from a global economic perspective, a very big deal from a Chinese consumer perspective. But again, that is going to be putting some disinflationary pressure out there in the world, which is what really we need in 2023.
Brian, before I let you go, I want to put you on the spot because one thing that I keep hearing about is that we're going to head back down to near 2% maybe in 2024, 2025. Do you think that that's true in terms of the inflation rate in the U.S. and the developed world, or do you think that we're going to have a protracted higher inflation kind of regime for longer?
So I think that, it's going to be tough to get that last percent and a half down. I think all the forecasts are sort of converging around 2.9 to 3.5% as the sort of the core PCE inflation for next year. And that raises the question of whether the Fed's going to accept that and say, well, look, mission accomplished, more or less. We've gotten the bulk of the inflation down. I think at the end of the day, the Fed will probably swerve and try to cut rates back down to avoid a recession. Once these risks become more balanced between leaving inflation in low threes, high twos, and risking a recession because you've kept policy restrictive for so long, I think the Fed blinks in 2024, lowers the Fed funds rate, and we live in a somewhat higher inflation world, although not one that's going to greatly bother people as long as wage growth is at least as high or higher than inflation, which I think in the positive scenario that we're expecting next year is going to be the case.
Brian, Nick, Nadia Lovell, thank you so much for being with us, and happy Thanksgiving. Coming up, the morning calls, and later Stifel's Barry Bannister seeing the silver lining, saying it's too late to be a bear. That conversation still ahead. Certainly too late to be a bear in today's market, with us stocks up ahead of the opening bell 6 minutes away. This is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro. Lift markets ahead of the open here on the holiday shortened week. S&P futures up by 0.5%. You can see NASDAQ trailing that up about 0.25%. And if you dig under the hood, you are seeing yields in just a touch. So this is sort of perhaps a bit of easing from how far those have to go. We are seeing 10-year yields at 3.78%. A little bit of dollar weakness, 102.63 on the euro US dollar cross, and crude higher. It's just shocking to see some of the volatility in that space, up 1.4% to $81.10 about in the WTI figure after yesterday's whole whirlwind about whether or not there would be some sort of output increase from OPEC Plus pushing that back and saying not so quickly. Joining us now with a look at the stocks moving at the opening bell, here's Abigail Doolittle. Abby.
Retail earnings continue to come in, Lisa, even at this late date. And we have a lot of discretionary stocks that are popping, including Best Buy. Shares are sharply higher, up about 6.5%. This after sales fall about 11% on inflation, but it's the outlook that's more positive. Comp sales coming in, really outweighing that drop in sales plus negative color. Abercrombie also really soaring, up about 17%, a narrower loss, 5% sales beat. They also posted a better sales forecast. This is a real hot and cold retailer, but right now it seems like it's hot. Barry Bannister just talking about the short interest or the short squeeze out there. There is a high short interest on this stock. That could be a piece of it. And Urban Outfitters, another retailer beating. As for a puzzling one, though, Lisa, Dollar Tree, it's down 6.5%. The quarter was okay, but the fiscal year earnings now seen at a lower end of the range. Medtronic, an entirely different sort of a company. Its earnings, a med tech company, its earnings coming in weaker than expected, and really the outlook disappointing on slower procedure and supply recovery. And then finally, Tesla trying to eke out a gain, its first gain in possibly 5 days. This is yields are down, helping out tech. And speaking of up, Lisa, we have crypto up, Bitcoin, I should say, up about 3%. That's helping out the crypto space, including Coinbase, up about 3% on the session.
Abigail, thank you so much. Meanwhile, hedge funds cutting risk, seeing the stock bounce as a bear market trap. Vinu Krishna of Barclays writing, quote, current multiples are baking in a sharp moderation in inflation and ultimately a soft landing, which we continue to believe is a low probability event. Though we're likely past the inflation peak, it does not mean we are past the equity market trough. Joining us right now, Bloomberg's Katie Greifeld. Katie.
Lisa, you're right. Hedge funds have been strangely MIA from this recent rally. We have data from JP Morgan tracking long, short funds, and they've pared back bets in both books after pretty much being forced to cover their shorts in this latest bounce. You're looking at a basket of the most shorted stocks versus the S&P 500. As you can see, it's pretty much the same chart, almost there. That's painful for some of these short sellers, and that tepid risk appetite can also be seen in the options market. Let's look at open interest on both puts and calls. It has been dropping over the past few weeks. Of course, the trend is definitely higher versus this time last year, but starting to ebb again just in the last month or so, even with uncertainty building into year end. And Lisa, we haven't even talked about crypto. Hedge funds could be looking at billions of dollars stuck at bankrupt exchange FTX. We got a list of its 50 biggest creditors over the weekend. More than $3 billion owed. That is just amazing. Now, that list was redacted, but we know there could be up to 150 crypto hedge funds with direct exposure, Lisa.
And what the potential fallout from that is TBD. Katie Greifeld, thank you so much. Goldman's Peter Oppenheimer expecting the bear market to continue. Take a listen.
There is a lot of optimism now that the pace of rate increases is going to slow as central banks get a little bit more confident that inflation is closer to a peak. But that said, we don't typically get markets reaching a trough until interest rates actually start to come down. And we're still a long way away from that.
Bloomberg's Kaylee Lyons is back with us. Kaylee.
2022 has not been a pretty year for the equity market, and it might not get prettier anytime soon. Granted, it has gotten maybe less ugly over the last, say, month or so as inflation data has come in cooler than expected, and we have seen somewhat of a rally. The question is, where do we go from here, especially looking into 2023? And still, the S&P 500 is down about 17% year to date, with, of course, losses far greater for tech stocks. The NASDAQ 100 is down more like 29%. And, of course, that is a result of higher borrowing costs. The 10-year yield is about 230 basis points higher today than it was at the start of 2022. And that, of course, is due to higher Fed rate expectations. That terminal rate continually getting repriced upward as the year has gone on, now up to about 5.2%. And we know that Fed speakers like Jim Bullard in recent days have said there's even upside room from there, and they might stay up there for a while. It is the higher rates for longer theme, and we have strategist after strategist saying until that changes and we actually get a pivot, it's going to be hard for risky assets to do well. Credit Suisse expecting muted equity performance in the first half of next year before we get past peak hawkishness and then a better second half. Bank of America echoing something similar. They see a potential bottom in the first half. And Marko Kolanovic, what used to be the ultra bull over at JP Morgan, says that until the Fed starts cutting rates, assets will be range bound with a more pronounced downside risk. And that is pretty much consensus for the year. If you look at the average year-end target for 2023 for Wall Street, 39.31 is what we're looking at. And where do we trade this morning, Lisa? 39.66.
A huge far cry. Kaylee Lyons, thank you so much. Stifel's Barry Bannister expecting a winter melt-up to fall victim to a summer slump, writing, quote, after an S&P 500 rally to 4,300 by April 2023, the Fed's overactivity now, with longs and variable lags, may just lock in a summer recession 2023. Anyway, Barry, I'm pleased to say, joins us now. Barry, we just heard a whole host of bearishness. We just heard all these people, even Marko Kolanovic over at JP Morgan, starting to feel bearish. You think it's a little bit too much. Why?
Yeah, we went into this year with a double-digit first quarter expectation of a decline, and we timed the three bottoms fairly well, but we did not time the two intermediate tops. You know, we had a top in the summer in June or August, and we had another top after April before that. Our view has been that if you look at the market in real terms, which is really the only way to look at it, inflation adjusted, the mean, the trend mean, and the median of the 13 bear markets surrounding recessions the past 90 years since World War II It's 31%. And you know what? We fell that far, 31% year to date through the October 16th low. So it is a little late to be a bear. We have to time the next recession. The market typically rolls over about 1 month before a recession. It peaks maybe 6 months before, but you notice the rollover about 1 month before. And I don't see a recession in the next 6 months. So we have a window of opportunity here for a rally, which we've been playing.
So how much can you play that? I mean, do you play that within specific companies based on earnings, based on forward looks, or do you base that just simply on evaluation?
No, Lisa, we look, we view it as a trade-off between really two major groups, cyclical and defensive. And so within cyclical, having been dominated by defensives year to date, within cyclical, we do feel like the financials, even the semiconductors, tech hardware, housing, which is technically making a double bottom and looks like it would be the biggest beneficiary of a narrowing of fixed rate mortgage spreads, which are really blown out versus what they should be. And retailers, if oil comes down. So we have to watch oil really closely, but retail would benefit if oil comes down. And those are the ones we would play as cyclical over defensive. Small caps are included in that more cyclical profile. And that's where we have been in the last few months.
When you talk about small caps, the argument for a lot of people was that the U.S. was doing the best out of all the world's biggest economies, and that it would remain so, and it would also remain immunized from the strong dollar and the potential deteriorating effect on business outside of the U.S. That story is shifting as people talk about peak dollar, as people talk about Europe doing better, perhaps next year, and China as well, resurgent. How much do you buy that will be a new narrative where small caps will not do well next year?
Well, in specific to Europe and not so much small caps inside the U.S. and Europe are sort of two different questions. But specifically to Europe, I have been impressed with the fact that they've been able to adjust to a much higher average energy cost and higher labor costs. Europe is very much a coiled spring, poised to rise as the dollar tops. And I do think the dollar is topping. So I like international investing. Small cap is another beta play on this kind of cyclical theme. But international looks particularly interesting to me, and I'll be spending a lot more time on that. I plan to the next 3 months.
With respect to China, are you also one of those who thinks that holds a great degree of opportunities just simply because of what we've baked into valuation so far?
China will eventually reopen. Okay, there have been some issues regarding their handling of COVID, having lacked mRNA vaccines and not purchased U.S. And European-made vaccines, which might have ameliorated some of their problems. But China will reopen. It will be bullish for global GDP. It will be bullish for cyclicals when it occurs. So I am thinking that they're inching towards that. But over the course of the winter, when virus cases typically surge in the Northern Hemisphere, I would be a little more circumspect that maybe the punch from China will occur more towards the summer and not so much immediately in the winter months.
Barry, we're talking about companies and how much they can be resilient into next year. And we're getting a slew of earnings, particularly in the retail sector today, Abercrombie & Fitch, Dick's Sporting Goods, a whole host of others. And it continues to show resilience. People are spending. People have the ability to do so, and they're upgrading some of their forecasts. What do you make of the optimism, the strange optimism, and based on expectations in retail that we've seen so far to date?
Well, it's not so much strange in the sense that because of pandemic savings combined with enormous government spending facilitated by the Fed and handouts to individuals and businesses, we built up $2.5 trillion of cash that has led down in the last several months to the high ones, so like 1.7 trillion of cash. People have the money to spend. They grumble about the inflation, but they have the money to spend. And that has helped keep the retail sales up. I expect that to continue.
So what do you think will be the returns, Barry, just to sort of sum up here heading into a tumultuous 2023? What kind of equity returns can investors expect next year, the year after, perhaps over the next 5 years on average?
I think most of the returns will be made in the first half, particularly through about April 30th. I tend to be on the cautious side. I'm looking at about 9 or 10% upside for the S&P, obviously more for the higher beta or the small cap trade. But I do see the direction is up. The recession risk is more late summer into the fall. And since a recession is a meaningful across-the-board decline in income production, sales, employment, and fixed investment, we have some spotty weakness there, but no one can adequately explain that we're actually having weakness across the board in those areas, particularly on the employment side. So we'll see the economy hold up at least into through the second quarter. We'll see about third quarter. That is some risk there.
Barry Bannister, you're sticking with us as we parse through how to navigate. Coming up, the crisis in crypto deepens, but how far is the reach?
I think the next leg of this is going to be, wow, what happens to the economy? You start looking at the amount of money that was being spent by even FTX on advertising, crypto as a whole.
That conversation coming up next. Right now we are seeing a bit of a gain as we see the first 12 minutes of trading pairing, though, a bit, 0.2% gain, 39.58 on the S&P. This is Bloomberg.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, ARK Investment CEO Cathie Wood. That conversation at 4 p.m. in New York, 9 p.m. in London. This is Bloomberg.
I think the next leg of this is going to be, wow, what happens to the economy? You start looking at the amount of money that was being spent by even FTX on advertising, crypto as a whole. I think this is going to feed into the economy. I think the wealth effect is real, right? This time we've lost $3 trillion down to just under $1 trillion.
Academy's Peter Cheer expecting further contagion from the crypto crisis. The fallout continuing with yet another brokerage sounding the alarm. Genesis looking to raise funds, telling Bloomberg in a statement, our goal is to resolve the current situation consensually without the need for any bankruptcy filing. Genesis continues to have constructive conversations with creditors. This coming as FTX is expected to make its first appearance in a Delaware bankruptcy court today. Bloomberg's Sonali Basak has been covering all of this and breaking the news. Sonali, thank you so much for being with us. What's the latest here and understanding where we are in the crypto fallout?
Lisa, I want to bring us inside those continuing conversations as it pertains to Genesis, because as we've reported, they have reached out to a lot of players, larger and smaller, to try to really fill that $1 billion hole as it pertains to Genesis lending. Now, in the 6 days since they've halted withdrawals since last week, they have sought $1 billion or more of fresh capital, and they've warned those investors, as we've reported, that they would have to file for bankruptcy without new funds. Now, the reason Genesis matters so much to this industry, of course, is because it has a lot of institutional backing behind this firm, a lot of institutional counterparties. So all of a sudden, you're seeing that crypto contagion start to become a bigger issue potentially if you saw a bankruptcy filing from Genesis. Now, let's talk about FTX, because, of course, in a couple hours here, we have FTX starting that bankruptcy hearing in Delaware courts. Regulators around the world and its own customers are very interested in what will happen here. You do have a lot of detail already out there, more than $1 billion of cash that could be at play here. They have hired an investment bank, Perella Weinberg, to seek potential asset sales as well as recapitalizations of certain assets. And we know that they have the largest 50 creditors have billions at play here. The top 10 creditors, even more than that, tens of millions to hundreds of millions of dollars per counterparty at risk at FTX. Now, who gets their money back? Because at the end of the day, if you have $40,000 with FTX, do you get anything? Do you have any sense of recouping even a portion of those funds? Or is the money saved for the big guys here? This will all play out in real time. We have never seen a bankruptcy like this before, but can anything of the past from prior financial bankruptcies play any role here? Wanted to just point out the contagion here. You're a bond girl, I'm a bond girl. Coinbase, of course, is not wrapped up in any of this, yet their bonds are trading at just over 50 cents on the dollar for notes maturing after 2030 here. Why? This is a company with $5 billion on its balance sheet. It is publicly traded. It is regulated in the United States. So you are seeing investor fears roll over a little more. How long that lasts for won't be answered until some of this shakes out.
Sonali Basak, great work. Really interesting there about Coinbase, given some of the skepticism about what other companies might have to become insolvent or face some sudden and serious pressures. Joining us, Barry Bannister of Stifel, who has been arguing that the crisis in crypto is more contained, writing, quote, there is wealth destruction, mainly the 20 to 30-something crowd who fell under the spell of decentralized finance and didn't understand the history of financial mania. Is Barry Bannister still with us? Is that what you would call this? A financial mania that is bursting?
Well, I think obviously blockchain has tremendous potential, and decentralized finance is one means to get there. But if you, as I do, I spend a lot of time on financial history. If you look back in the past, for example, the wildcat banks of the 19th century, many of these banks that were not regulated adequately failed. And so what's going to happen right now is they're going to have their moment of failure. They've got commingling of their own trading accounts with customer accounts, which is absolutely verboten in the traditional finance industry, and they need to be subject to those rules. They need SEC regulation. But once they get that, there are a lot of great potential outcomes in the DeFi industry. But the good thing about DeFi is they held themselves out as separate, and so they're not as connected to the rest of us, and there's not a lot of spillover other than the wealth effects.
Well, but what about the brokerages, right? The companies like Coinbase, like even the Wall Street banks that have built out trading desks specifically for crypto assets that might not be a part of the decentralized finance kind of world, but something that is more of a speculative instrument. Have we seen the entirety of that fall out?
Well, as you know, after the Dodd-Frank Act, prop trading pretty much went away. So the exposure of the capital accounts of Wall Street banks is minimal because the trading activity is not going to spill over. But yeah, there's wealth destruction, and it does have a small.
I think that we've lost Barry Bannister of Stifel. Thank you so much for that. We have been talking about banks really being immunized because of how much capital they've had to hold and some of the new regulatory actions that have been passed post-2008. Let's get to Abigail Doolittle, who's looking at some sector price action this morning. Abby, what do you see?
Well, Lisa, you know, it's really interesting because we do have stocks off their highs, up 0.3%. Would you be surprised to know that is on volume that is 32% below the 20-day average? Of course not. It's Thanksgiving week, so of course it's very small moves here relative to the volume, but some bigger moves for some sectors, including energy on oils bounce back up 1.3%. We also have utilities up 1.2% with yields going down. Those dividends look better. Flipping to the bottom of that board, tech, though, interesting, the yields down is also lower. Those three mega cap sectors probably has to do with China tech still weighing through to U.S. tech. Let's focus in on energy, though, because the big story on the year, energy, the only sector of all 11 S&P 500 sectors higher, up 65% after rising 47% last year. Well, again, it's today's best sector, up 1.3%. We also have the XLE up about a commensurate amount. Some of the individual players, though, Lisa, they're up just a little bit less, up 0.6%. And Schlumberger, the driller, up about 0.5%. This continues to be that area, though, Lisa, that investors are hiding in this year. Again, all 11 sectors, or 10 of the 11 sectors down, energy higher. Every portfolio manager and strategist that seems to come on Bloomberg television talks about energy being the place to be.
Yeah, indeed, Abigail. Thank you so much for that. Right now, in markets more broadly, you are seeing that lift fade just a touch as people parse through Fed speak, as companies buy back their own shares, pick up whatever technical reason you want. You're seeing the S&P now up about 0.33%, the NASDAQ down a little bit less, yields slightly lower. There's stability in yields, which is one precursor for a lot of people. Dollar weakness really building on what we've seen over the past few weeks, feeding these feelings that perhaps we see peak dollar next year. Coming up, the market moving events that you need to be watching. That's next in our trading diary. This is Bloomberg. Time now for the trading diary you need to be watching this week. Before we get there, we are seeing a lift in the S&P. Interesting, the NASDAQ has lost steam, down about 0.33%. The Russell up about 20 basis points. We're looking also at bond yields coming in just a touch as we look at some stability there after a really tumultuous year. Taking a look at that 10-year yield, we started the year at 1.5%, 3.77% now. The White House briefing, we are things that we are watching today, 11:30 a.m. Fed speak continuing with Mester, Bullard, and George, all on deck for today. Fed minutes out on Wednesday, followed by a host of data, the data dump, including initial jobless claims, new home sales, U.S. PMIs, and the University of Michigan Consumer Sentiment Survey. And finally, U.S. markets are closing for the Thanksgiving holiday on Thursday. Good luck with Friday kinds of office activity. It is a time to clean out the office or just take time off in the United States to be with family. This was Countdown to the Open. This is Bloomberg.